Good afternoon. My name is Charles Stewart, and I am the Managing Partner of Market Partners, and welcome to the Fund Manager series. When I think about the role of the advisor, it's to sit down and deeply understand the goals and objectives of the client, and to go away and find the best performing fund managers, the longest track record of outperforming their benchmarks, and then try and drive the fee as low as possible. Today, we're lucky enough to have Ben, the Chief Investment Officer from Avari, in to talk to us about how they manage our clients' capital. Ben, welcome today.
Thank you. Thanks for having me.
Yeah, can you tell us a little bit about yourself and about the fund Avari?
Certainly. So I've been in the credit space for about 25 years. Started my career in finance in Macquarie Bank, spent 15 years there, finished up in 2015, moved to Oaktree, one of the largest credit fund managers globally. Did 8 years there, leading the Australian real estate function for Oaktree, and subsequently moved to Avari around 2 years ago. So I've had quite an experience with both local institutions, global fund managers, and now back to a boutique real estate focused credit manager.
Yeah, nice. That's really interesting. So when we think about allocating as a financial advisor into defensive and growth investments, we've come across a lot of accounts recently where a typical retail financial advisor will allocate into Australian fixed income and international fixed income. And when you delve underneath the hood, like the Western Asset Australian Bond Fund over the past 5 years has printed 0.22% and is highly recommended on the Lonsec platform. When I'm allocating into defensive areas, which is how I see your portfolio, your fund sitting, I think about trying to maximize returns from it. And so allocating into private credit has traditionally delivered strong risk-adjusted returns. There are some things that we're looking for when we're allocating that space, but can you talk a little bit about the types of investments you're making in the Avari fund?
Certainly. The Avari fund is a very simple product, and we've set it up to be unashamedly simple. We only do first mortgages. We only do first mortgages that are secured by real estate assets that we're comfortable with the current valuations on those assets, and that we're comfortable that there is a deep end market for those assets.
Yeah, interesting. So 9.5% return over the past 12 months, 10.58% returns over the past 3 years. You've been a great custodian of our clients' assets. When you think about the underlying investments in the portfolio, can you talk a little bit about what space you're investing in? Because the first mortgage universe is quite wide.
Yes. Well, look, the way we try to see the world in terms of our originations is our ambition is to see as many deals as we possibly can in any given time frame. And from those deals, to be able to allocate to the best risk return. So we don't go out with any preconceived portfolio construction. We're very much looking for the best risk return available in the current market. So what does that mean? That means we're typically looking for low leverage and high return. And we don't have to do every deal. We only do the deals that really work for us. Where are we allocated currently? We're allocated substantially to residential projects. Most of it is either land subdivision or completed stock without construction risk. We have no particular bias against, say, high-rise construction. However, for the last half a dozen years, 10 years, we've seen it as being the risk reward as being unfavourable relative to other places where we can deploy capital.
Interesting. So there are a lot of private credit players out there and property private credit players out there. Some of the big managers out there that people would know, the Merricks and the Metrics and the like, my understanding is that they have to take a small slice of almost every single deal because they have to deploy so much capital. Can you talk about the level of funds under management you're managing and whether or not that gives you some ability to be much more selective on those underlying investments?
Yeah, we're managing about $1.5 billion at the moment. and that's split across about $1 billion in the private credit space, about $500 million in syndicated real estate equity trusts that are direct asset owners. So being at that smaller end of the scale, we can be quite patient and selective. And really, in credit, it's super important to miss the losers, and that's where problems come into a portfolio. It's not only the economic loss; it's the time sink that's involved in managing underperforming assets. And so, really, the hard work needs to be done up front when you're doing the diligence and understanding the business plan, to be very thorough and consistent in your approach to underwriting the assets, to understanding the risks, and to, most importantly, not go into the losing deals.
And I think also one of the other areas that I think you guys are good at is actually on the loan doc side. Can you run me through what your philosophy is in that space?
Certainly. So in terms of our clients, our borrowers, when they come to us with a business plan. And as a credit provider, we are providing capital to those clients to deliver that business plan. And we're accepting certain risks that we understand at the point where that asset is originated. Now, again, in terms of avoiding losers, one of the most important things to do is to make sure that when things do go wrong, you have a chance to go and revisit your position and to understand what has gone wrong, why it's gone wrong, and whether there's a pathway through to remedying that problem. So our loan documents are very much tailored to the business plan that has been presented to us to ensure that the risk that we have accepted and the return that we're receiving for our clients for that risk is appropriate and remains appropriate. To the extent that something goes wrong, and that happens, and that's a normal part of credit, the important thing is to be able to act early when there is still, clear value there to be preserving for clients.
Yeah. So also from an advisor's perspective, as the advisor for and the custodian of our clients' funds, what we want to see in this space from a high quality advisor who we actually allocate to is high communication about when things do go awry. And I think this is one of the areas that does set Avari out from some of the other managers out there, as they do get on the front foot and clearly communicate to advisors and investors in the monthly updates about when a loan goes into arrears. Is that the right terminology? Or no?
Enforcement.
Enforcement. Yeah. So there's been one that's been on the books for probably about 6 months, a land subdivision, I understand. Can you give me a bit more information about how that works and some of the economics behind it that have ended up flowing to investors? What was the original risk and what's the outcome today?
Yeah, certainly. So transparency is hugely important to us. So not only do we present the full loan book in our monthly updates, we give an update including a warts and all update. And so where things have gone wrong, it's important, as it is for us, to understand the risks for our clients or our borrowers, for our investors to understand the risks and how we're managing those risks. In the case of the land subdivision, there was a dispute at the owner's level that didn't necessarily go to the value of the underlying properties, but did change the risk profile for us as a lender. We don't want to be involved in disputes between joint venture partners in a land project. And that certainly wasn't a risk that we signed up for. Our documents had clear defaults where there is litigation, as all good or well-structured debt documents should have. So, look, we did go down the path of trying to negotiate with our borrower to reach a settlement and have the dispute resolved amicably, or at least to our satisfaction. And that didn't occur within a time frame that we were comfortable. So we had no choice. And when you're protecting clients' money, it's not a choice thing. You've got to do the right thing. So we did appoint receivers. We then went through the normal process of running a sales campaign. The sales campaign has been successful. The asset was sold at valuation. There's plenty of equity cover for full recovery.
So maybe just on that. So if you lent out $1 on those projects, there are two underlying assets. The first one had already been sold. The original $1, let's say the project was worth $1. You only lent 65 cents against that, approximately. The first project was sold. How much did the first project cover of the 65 cents that you lent out?
Well, in that instance, the first project covered 65 cents.
There we go.
So
and then for that period of time, you were then charging a default interest rate.
That's correct.
That flowed through to investors 100%?
That flows through to investors, that's correct. And the asset that we have sold has been sold on deferred settlement terms. So even though now the risk has changed and it's in our benefit, or our investors' benefits, the default interest will continue to accrue until that loan is finally repaid. So it's a good outcome for investors. Now, we're not in the business of trying to create defaults to get that additional return, that it's a bonus return, but our business is more focused towards performing credit and delivering investors the return that we expected to deliver based on the original transaction.
Yeah, interesting. I think that's a great example of those things that we're looking for: transparency, solid loan docs, and the ability to be able to protect investors and deliver a higher return. When I think about the current market environment, Ben, and the current government trying to take away negative gearing, and we're seeing across the country clearance rates dropping, do you see that as being a higher risk for your underlying portfolio? How do you think about that?
Well, look, it does. I mean, whenever there is a change, there's unintended consequences. And we don't immediately know what those unintended consequences will be. The changes that have been introduced through the budget are meaningful changes that will affect the property industry and, in particular, residential property. There's no surprise that there's a slowdown, and look, there may well be some price falls in certain markets. The fundamentals are still pretty good. There's still a shortage of supply. Population growth is still strong. Unemployment rates are still very low. Interest rates, are stubbornly high, but they're not at historic highs. They're still, by and large, manageable. So, we don't see a catastrophe happening anytime soon, but we are mindful that the risk has changed. And again, in a credit position, you do have the downside protection of the equity that is sitting in front of you. And we do need to keep mindful of that for both the managing the existing portfolio as well as for new transactions that we enter into. But at least from the perspective of the changes that have been announced, they're now a known unknown. So we just don't know precisely how it's going to play out into the market, but we can at least accommodate that in our underwriting.
Well, it looks like Pauline Hanson's going to be the next Prime Minister of Australia. I wonder what she's going to do. So, one of the things that I get asked by other advisors who don't allocate into this space is, where does this actually sit in client portfolios? And so when I think about, trying to manage not only the right asset allocation between growth and defensive, but within defensive, trying to get the right allocation between the liquidity profile of the investment. So you still need to have your daily liquid fixed income funds there, but then Avari really sits in that private credit portfolio where you're getting materially higher returns. And with manager selection, I think we can get, consistent higher returns with reduced risk through the cycle. And that's going to drive a better, overall portfolio returns for clients. Do you have any other advice for advisors who are allocating into this space?
Well, look, I think the important thing you've touched on it is manager selection. The simple products will tend to hold up better than the complicated products, and in terms of the way that we have set up our product, we have we have a very transparent process. We publish monthly our loan book, and full transparency on the rates that we're charging to our borrowers. We take an agreed fee share that is, again, thoroughly disclosed. And so from our perspective, the clients, our investors, are receiving the return, the full return, net of the fees, for the risk that they're taking.
Ben, one of the things that clients don't know is about how the fees are structured in these sorts of funds. Can you give me a rundown about how Avari structures the funds under management fee, the origination fee, and any default interest, and what flows through to the investor?
Certainly. So again, in terms of the Avari product, we have deliberately kept it very simple. We charge a base management fee of 50 points on the AUM. We retain the origination fees for onboarding each loan, and with default interest, 100% of that is passed through to investors. And we think that's important. We think that the transparency is important because we believe that it drives the right outcomes in terms of our origination being aligned with the interests of our investor base. And we also believe that with the default interest, when the risk has changed for our investors. And so they should get the benefit of the increase in the return that comes through from that change in risk. Now, a lot of other managers do retain a share of the default interest, and a lot of other managers do have a fixed coupon that they pay to their investors regardless of the return. That has been identified by ASIC in some of the product reviews. We've tried to maintain a very simple fee model.
So maybe a follow-on question about that. There are some providers out there in the private credit space who market their product as a term deposit, say, for example, paying 6.5% interest. Without pulling up any specific names, what do you think are the underlying investors in there, and are those investors getting paid accordingly for the risk that they're taking with that product?
Well, I think the problem is that if you're in that type of product, it's not clear. And, there are those types of products are often backed by similar loans to the loans that we're writing. So an investor in our fund will be getting a greater share of the return than an investor that's receiving a fixed coupon on a like-for-like basis.
I mean, 6.5% and 9.5% is a big difference, isn't it?
It is a material difference. And again, without knowing perfectly what's sitting behind those assets, and investors don't know it, and ASIC has made that point in their review of the sector. And I frankly don't fully know, but I do know what our competitors are originating in the market, and I do believe that some of that is finding its way into that style of product.
Yeah, really interesting. Well, I think this has been a great interview today. I feel like I'm grateful to have found Avari and for you guys to be custodians of our clients' funds and to continue to deliver those returns. So thank you very much for coming on to the Fund Manager series, and looking forward to our next catch-up.
Fabulous. Thanks for having me.